now we have Liz Sanchez from Genworth, which is a mortgage insurance company, and I will leave it at that. Did you want me to move? Okay. Oh, hang on. Sorry, I got it. Have a pocket or something?
Yeah, just slip it back here. Great. Well, good evening, everyone. It's just so delightful to be here with you all on this fine evening. My name is Liz Sanchez, and I'm an account manager with Genworth Financial Canada. I've been there for almost 6 years now, and prior to that, I was working for one of the big banks, and I won't name which one. So approximately 10 years in the industry, and I'm really passionate about what I do, about home ownership. You know, we've branded ourselves as the home ownership company, so any chance I get to come out to one of these things and you know, perhaps impart a bit of my knowledge on each and every one of you to perhaps take that, you know, courageous step forward and jumping into home ownership. I myself became a homeowner in 2006. Just a year before the prices peaked, so it was a little bit intimidating at the time with what the prices were at right now, back then rather. But we jumped in. I mean, it was the right time. We fell in love with our dream home, and as Chris said, I mean, it's never a wrong time to buy your dream home. So luckily now, you know, we're definitely in more of a buyer's market, so it's absolutely a great time. We've got phenomenal rates out there right now, and I'm sure John will touch upon that. But what I'm here to talk about is who Genworth Financial Canada is, home ownership, exploring some of the choices that you have available to you, how easy it actually is to own your own home, and making more of your down payment. Okay, there's so many options out there and different ways to get a mortgage, as Chris alluded to, and just talk a little bit more deeply about what you'll experience when dealing with Genworth Financial. So Genworth Financial Canada, we are a private mortgage insurer. There's 2 private mortgage insurers in Canada as of today. There's also a Crown Corporation. You may have heard of them, CMHC, Canadian Mortgage Housing Corporation. That's the only time I'll say them in my presentation. So they are a Crown Corporation. We are privately run. Okay, so there's a big difference there from a corporate perspective. We are a global leader. We do operate in 26 or 27 countries internationally. What that allows us to do is think of really creative products and things that benefit consumers based on information that we gather internationally. I mean, certainly we're not exactly the same as the US, thank goodness for now. That's a good thing. But you know, certain things that we learn from other countries like Australia or the UK or Japan, there are direct applications here in Canada for sure. We work with partners, with industry partners, people like Chris, people like John. You know, we keep our network very broad, and that actually benefits you, the end consumer, at the end of the day. As well as we have a variety of unique programs that actually benefit consumers. So I think the biggest misconception between mortgage insurance and life insurance, people often take it as one and the same when you're getting your mortgage. Mortgage default insurance is mandatory. For any client who has less than a 20% down payment, the government requires that they have this type of mortgage insurance on it. So if should something happen down the road, knock on wood that it does, you know, you're covered basically. I understand that, you know, it is covering the bank against any type of default, but it actually benefits the consumer and it protects you. So because we're branding ourselves as the home ownership company, we want to get Canadians into homes and make sure they stay there. So I'll talk a little bit about how we do that kind of halfway through the presentation. So mortgage insurance is a one-time payment based on your mortgage amount, whereas life insurance, mortgage life insurance, you know, that's a kind of a monthly ongoing thing. So it's a one-time payment, the mortgage insurance. It's required, as I mentioned, federally for anyone who does not have a 20% down payment, and it's only in the event of mortgage default, job loss, illness, marital breakdown, anything that prevents you from being able to pay that mortgage, we step in and help, okay? There's 2 types of mortgages. A conventional mortgage, meaning you do have a 20% down payment, that's called conventional, and then a low down payment insured mortgage, or oftentimes it's referenced as a high ratio mortgage. That's where you would have as little as a 5% down payment, okay? So moving right along, in terms of peace of mind, I mean, you have the freedom to choose. I'll never forget the time I was doing a home buyer seminar similar to this one, and There was a gentleman in the audience, and he had a very unique situation. He was self-employed, he had a tough time proving his income, a lot of cash transactions, that sort of thing, and he had been renting for 10 years. Just to give you an idea, Genworth brought a product to the table that addresses clients like that maybe 7 or 8 years ago. So anyways, he puts up his hand and he says, Liz, so what you're telling me is if I go in and talk to my broker, they can get me a mortgage based on my unique scenario. I said, yeah, they definitely can. Here's my business card. Call me once you've spoken to them. So 2 days later, he called me and he was just over the moon with happiness. He got his mortgage approved. So you saw that calculation that Chris put up there in terms of what the cost of rent is over years. This guy was renting for 10 years. So imagine what he could have accomplished financially through home ownership, right? So definitely speaks volumes. In terms of owning a home, you know what? There's lots of studies that have been published lately actually with individuals who are on the fence. They're thinking about buying a home. Provided that you're currently employed, you know, a lot of the news media that we're hearing right now, it creates fear. The facts are rates are phenomenally low, prices have stabilized, so getting into these bidding war type situations, probably not as likely right now, and that sort of thing. So home ownership is more affordable and attainable now more than ever. With regards to the actual mortgage insurance premium, it is determined based on how large the down payment is. So obviously the more down payment you put down, the smaller the premium would be. So I was out to lunch with actually dinner with a girlfriend of mine, and she was not in the greatest of spirits. And I said, well, Margaret, what's wrong? You don't seem yourself today. And she says, you know, it's been really tough. I've been renting for 4 years, and I'm saving to buy this condominium. And I said, okay, well, that's all fine and well, but what are you doing wrong? 4 years is a long time. You haven't been able to scrape up even 5%. And she says, well, no, actually, I'm waiting to save that 20% because I don't want to pay the mortgage insurance premium. And so my jaw hit the ground and I said, hang on a second, have you forgotten where I work? You know you're going to get the talk right now. So anyways, long story short, without making it sound like a sales pitch, I asked her, I said, 4 years ago when you could have bought that condominium off the blueprints, what was the list price? And she said $180,000. I said, okay, well, what is that house worth today or that condo worth today? She says, well, I've seen units going for about $250,000. This is in Toronto. I said, okay, well, when it was $180,000, what was that one-time mortgage insurance premium fee? She said $4,000. I don't remember what the amount was, but it was negligible compared to paying an additional $70,000 on the purchase price, right? So we all have to think big picture and kind of digest it piece by piece and really make a smart decision there. So just as an example to illustrate, so a conventional mortgage, let's say you're buying a home for $100,000 and you want to go conventional, meaning you don't want to be in a high ratio insured individual. So the required down payment would be $20,000. I mean, I don't know if any homes in this area are, maybe if we go really far down to Windsor, perhaps you might be able to pick one up for in and around that range, or maybe in the East Coast, but certainly not in this general area. You probably won't find something for $100,000. But as an example, with 20% down, you need a $20,000 down payment. If you put a 5% down payment down, the required down payment would be $5,000. So just to give you an idea of how that works and what the difference is. Statistically, they say it takes, on average, to save that 20%. Actually, I'll throw it out to the audience. How long would you think it would take you to save a 20% down payment? Think of the average house that you're looking at or something that would be kind of within your price range. If you wanted to put the 20% down payment, how many years do you think it would take you to save that? Let's a while, right? Let's say the average home is about 200 grand. That's even on the low side. That would be $40,000, let's say. It's not that easy, particularly if you're paying rent. I mean, certainly if you're living at home and rent is free or really cheap, makes it a bit easier, but not a lot of us have that luxury. So it does take a lot of time. They say on average between 4 and 5 years, okay? At the same time, housing prices are appreciating, right? So you're trying to kind of catch a falling knife. You know, I don't want to use that cliche, but it's true. You're constantly playing, you know, catch up. Again, here's another example, you know, with a purchase price that's higher, $175,000 purchase price. We've gone up the scale, $75,000 on the purchase price. And to do that 20%, it now jumps to $35,000, right? Again, with the 5% down payment mortgage, you're looking at a down payment of $8,750. So huge difference, right? It's all about jumping in sooner, you know, monopolizing on a lot of the, you know, benefits there are to getting a